Hi there, Todd here, New Age Wealth Advisors. Welcome. Just get you updated on everything that happened today. Busy day. Fed raised interest rates, very telegraphed, expected 50 basis points, 0.5%. The new federal funds target is 0.75% to 1%. Powell gave us some good information. Market went on a very, very sharp rally. So let's dive in. Let's take a look here at some of the happenings today and look forward what we might expect. So what was interesting is Powell came right out of the gate, I should say, and spoke directly to the American people and said, look, we know inflation's too high, and we're very aware of it. It's not fair to you, the consumer, and we take that very seriously. And the market sold off. But then I think Powell took a much more dovish tone, which there's two terms that people who watch the Fed throw around: hawkish and dovish. Hawkish means in favor of tightening of monetary policy, which is increased interest rates and withdrawing liquidity out of the system to slow an economy down like we have now. And dovish is the opposite, in favor of lower rates, ample liquidity in the system to boost the economy. So I think he came out with less of a hawkish tone than I think a lot were expecting. And there's a few key things that he said, and the market went on a rip-roaring run here. So let me just pull this over, and I'll show you the kind of the scorecard for today. So the NASDAQ was up better than 3.41%. The Dow was up 2.8%. Pretty unbelievable move. We've got crude oil up to $108. Gas was up a little bit there. Natural gas, which has been on a tear, 8.45. Really good move there. The dollar did sell off. This isn't showing the latest. This is showing as the dollar's trading in Asia. Dollar did sell off, and interest rates backed off quite a bit. And that's a key thing that happened here. Basically, what happened is Powell said that he is not going to consider a 0.75 interest rate hike. And a lot of people are saying that perhaps he's going to do a 75 basis point hike. And he came out and said that's really not under consideration right now. So that I think that was kind of reassuring to the market that he's not going to come in and just shock the market with 75 basis points. So from there, he went on. He did reduce the size of the balance sheet, which I want to show you that. So the balance sheet is the Fed's holdings of treasuries and mortgage-backed securities. This is going back to 2008 when the credit crisis first happened. This is the first edition of quantitative easing, which quantitative easing is buying of bonds by the Fed. And remember, as bonds go up, the corresponding interest rate goes down. That's a Fed that's trying to take a dovish stance, which low interest rate stimulates borrowing and investment and hopefully fights off deflation, brings in some inflation. So the buying of bonds is quantitative easing, and the Fed is went from less than a $2 trillion balance sheet. Here's the credit crisis. Sort of let it run off in 15 and 16, and then here's the pandemic going up to $8.9 trillion in U.S. Treasuries and mortgage securities. And the Fed is going to go into a period where they're going to let this roll off. And basically what they're going to do is, starting in June, they're going to let $30 billion of treasuries and $17.5 billion of mortgage-backed securities, which is $47.5 billion, roll off. So they're not going to sell the bonds, but basically they're just going to let those securities expire, roll off, and not renew the purchase of it. Then after that, they're going to go to $90 billion a month. And I found with such large numbers, I had to put it on a spreadsheet. So the Fed balance sheet, this is what $8.9 trillion. Dr. Evil from Austin Powers. 8.9 trillion. And I'm thinking to myself, if you're better at math than I am, 47 billion they're going to let run off in month one. What percent of 47 billion is of 8.9 trillion? And it's only 0.5%. Then after that, month two, they're going to work up to $95 billion they're going to let expire per month. And again, that's only 1%. Mind-blowing. 95 billion is 1% of 8.9 trillion. It's just astronomical astronomical numbers. So, again, I thought that Powell came out of the gate and he was saying, look, inflation's a problem, we're going to take a head on. But then I thought he significantly reduced his urgency with inflation, and he seemed very comfortable up there. He really didn't, I think, indicate any urgency that they need to get it under control. And so, we have CPI coming up here. We have it next Wednesday, actually. We have core CPI. Here, let me show. So we have core CPI forecasted to come in at 0.4% month over month. Year over year, we're looking at 6.6%. And then the headline looking for a 0.2% increase month over month, and they don't give a projection for year over year, but 8.5% was the big reading last month. And if you remember, the White House came out and said we're expecting a massive number, and I thought it was such a strange announcement out of the White House. Everyone was thinking that we were going to get a 10% reading, and it really wasn't. It was 8.5%. So I think that there wasn't as much urgency out of Powell, and I think that kind of gave the market a little bit of confidence. So this is a chart that I've showed before that I want to put in front of you, which is the 2-year Treasury yield and the Fed fund futures. Okay, we've talked about this at length on this channel before, where everyone was saying, "Oh, we have 10-2 yield inversion, we have a recession coming," and then a lot of people said, "Well, hang on, the 2-year yield is not gospel in terms of where the Fed is going to set their interest rate. And when the Fed sets the interest rate like they did today, moving 50 basis points, that is impacting like 3-month and shorter duration maturities. There's times where the 2-year moves trying to get the Fed to move on that shorter duration, and it doesn't. I mean, look back here in, this is like 2003. The purple is the 2-year, orange is where the Fed funds is, or the purple went up, Fed funds says no thank you. Then all of a sudden, look, the 2-year was trying to move up, didn't really get it to move for some time. And you can see down here, this is the spread between the 2-year Treasury and the effective federal funds rate. Anytime it gets high like this, the spread is very large. And you can see it got up to 2% spread here, and eventually the 2-year caught back down. We got very high here in 2004, and again, eventually when the Fed was ready, it raised rates, and we're getting very high again here, where the 2 years up at 2.25. Fed funds is now 0.75 to 1%. So it's not, we might start seeing a little bit of perhaps a move down in the 2-year, easing off that spread. So the market just ripped after that. I mean, it was an unbelievable rally, and Zero Hedge, which is a site that I like to follow, put something out there, and this was, he showed that S&P percent change was the largest one-day move on a Fed rate hike since November of 1978. It was up 4%, okay? And Zero Hedge went on, and I enjoy reading them, but they tend to be a little sensationalistic. And they went on to show, and in fact, I can show you right here, they went on to say that the market made a new low after that significant update. And that very well may be the case. They said right here, well, there's the big up day from 1978, and then we proceeded to make a new low. So I got into that a little bit, and I said, well, let's take a look at that. And here's something I found that I thought was a little interesting and slightly misleading. So that move was right here. So this is November 1st, 1978. The Fed raised rates. And of course, this is coming out of the stagflationary 70s, which there's so many similarities trying to be drawn between the 70s, which saw high degree of inflation, a lot of stagnation in the economy. Of course, we had very high interest rates, crude oil's going up. Obviously, we had a lot going on the geopolitical front with Iran and crude, and really there was no economic progress here in the 60s and 70s. But what I thought was a little bit misleading from that chart is look at what happened here. The largest one-day rally, we made a slight new low right here. You can see my cursor at the bottom, November 17th, November 10th. But if you scroll out here a little bit, it was the start of a generational bull market. Okay, so we kind of drifted higher, had a setback, into 1982, but we went higher, and that's when the real bull market began. Okay, so a lot of people are saying, well, that was last time we had a rate hike like that was 2000, and the market sold off significantly. Well, that's another way to look at it, and I think I think that's pretty notable. Okay, so let's take a look at the sector reaction to this, and I thought this was quite interesting. So this is a 1-minute chart, okay, of the sector spiders. These are the 10 sectors that make up the S&P 500. So okay, so let me just stretch this out a little bit. So discretionary, technology, communications, which is like Google, Google and Facebook and big stuff, and Twitter and stuff like that. Financials, energy, real estate, healthcare. The big winner post-Fed on this massive update, this historic update, was consumer discretionary and technology. And the stocks that were doing the best were actually one of our largest, which was Tesla and Home Depot. There we go. So you can see Tesla just absolutely ripped up 6.5% after the Fed, and that's one of our largest holdings here in the growth portfolio. Tesla is at 7.26, just behind Apple at 7.27, and AMD is in the middle of those two, and we're going to talk about that. So Tesla showing a lot of relative strength here, despite everything that's going on with Twitter. And a stat that I found that was pretty interesting was so many people who are calling for a certain 10 rate hikes. We only have 5 Fed meetings here, but looking for another 250 basis points of rate hikes. And Powell was very clear today when he said, we really don't have certainty any more than 3 months out. And I was reading something from Tom Lee, who I really respect. He was saying, we have lost year to date between stocks and bonds about $13.5 trillion worth of wealth as the stock and bond market has come off. The U.S. GDP is about 26 trillion. So in the first 5 months of this year, we've lost 1/2 of the U.S. annual GDP. What that means is the wealth effect has come off, and that's going to make people feel less wealthy and more, I would say, less inclined to spend. And so what that's doing, the stock market is doing, is it's sort of acting as rate hikes without the Fed having to move. So it's going to slow the economy when that wealth effect kicks in. And the other thing is the dollar's been very strong, and the dollar is a way to sort of stem off inflation. Stronger dollar generally will help contain inflation a little bit. So that's also working for the Fed. Not a lot of people are talking about that. So from there, I want to talk about this. There's some headlines out there that I think are very misleading, and I'm seeing a lot of them out there. So let's take this headline right here. S&P is having its worst start to a year since 1939. I mean, you read that kind of thing and you're like, wow, that's miserable. And I'm seeing it everywhere. Okay, but if you look at the chart, let's kind of put this in perspective here. Okay, so here's the S&P. Okay, here's 2022, the start. We just happened to start the first week at the high, and we've gone straight down 15.7% lower in the first 5 months of 2022. And you combine that with that headline, worst start since 1939. Let's kind of put this in perspective and set the headline attention-grabbing stuff aside. Let's just scroll back and let's compare and let's say, what kind of other pullbacks have we seen in recent history? So as you kind of scroll back here, let's go back to the credit crisis, and I've outlined some of the most notable ones since 2009. So we have 2010, 17%, 2011, 21.5%, 2015 and 16, 15, 12, 20, 35. You get my point here? I mean, it's a pullback. It's a very average pullback, and we've seen 1, 2, 3, 4, 5, 6 of them, and it happens to be only the fourth most significant pullback in just the last, call it 12 years. So you got to kind of be careful what the headline is. And again, they're crafted and it's just a way to try to grab your attention. And like, look, so far it's a 15.5% pullback in the S&P, 21, 22% in the NASDAQ. But I mean, how much is this market up since the credit crisis? So let's go price range percentage. We'll go from the low. S&P's up roughly 544% from the lows. Let's go to the NASDAQ. I can promise you it'll be more. Oh my, I mean, just, you know what I'm saying? I mean, like just step back and take a deep breath and set all of the sensationalistic headlines and all the stuff that's being thrown at you. Just, this is why I love charts. You just step back, take a deep breath, and you say, okay, what do you really see here? This is the crash that everyone's talking about. And this is just from 2009. The NASDAQ in this time is up. I'm not even going peak to trough. I'm going to where we are right now. Roughly 1,600% in the NASDAQ since the 09 low. Okay, so let's take a look at this. These are the ETFs that I watch to look at the different market capitalizations of the growth versus the value stocks that we track. And this is the way I really like to break down the market. So we have growth, which are more tech stocks and communication stocks and consumer discretionary that have very aggressive top line revenue growth, not necessarily bottom line profitability. Compare that to older economy stocks that have more stable revenue and more stable profits. So we have value versus growth. And you can see since the start of the year, you can clearly see the top 200 value, mid cap value, and these are the small cap values are far outpacing where growth is. So this is the top 200 growth, mid cap growth, and small cap growth. So clearly there's a divide there. But what we saw and we've been seeing in the last couple days is perhaps I think the market is starting to realize that they've swung too far in one direction, thinking the Fed is just going to just blow up and just nuke this market and throw a bunch of rate hikes at it, anything they can to control inflation. And they're really trying to engineer a soft landing. We're seeing a return and sort of a leadership in some of these growth stocks. And our portfolios have been positioned since we launched in October, oriented more towards the value stocks like energy and financials. And that's served us very well. And I'm watching very closely, is it time to sort of rotate out? So we'll talk about that. And one stock that did do very, very well is AMD. And AMD just reported earnings, and basically they blew it out of the water. AMD is a holding in our portfolio. Currently, AMD is a 6.75% target. Current weight is 5.79. It's had a little bit of drift because it's sold off. But we just reported earnings. This was actually a nice technical pattern and sort of an A, B, C. Basically what happened is you had a 39% decline, rally back up, and then sometimes you'll see another 39% decline. It only got to 36.74, and then it's rallied sharply. We just reported earnings, and the earnings were extremely, extremely strong. So this is also following their Xilinx acquisition, and what happened was we had Xilinx as well in the portfolio, and basically we just got shares, more AMD shares, and that increased our holding in AMD. And I liked what was happening with this acquisition, so I just kept it, and that kicked it up to like a top 3 holding for us. And the earnings that we saw were really, really strong. So the revenues were about $5.9 billion for last quarter. Markets were expecting about $5.52 billion. So 5.9 to 5.5. Massive beat. Year over year from this time last year, they're up 70% revenues. They guided also for next quarter to 6.38 billion, and markets were looking for less than that, so they guided very well. Looking pretty good. And this acquisition of Xilinx, it's proving to be pretty strategic for them. It allows them to play in the auto space, data centers like high performance computing, which is chips for servers, And then they also do custom chips for the chips that go in the PlayStation 5 and the Xbox. They're also increasing the revenue in cloud, which is very important. Lisa Su is the CEO. She did acknowledge that softening PC sales, which did hit Intel, is not impacting AMD that much, because we did see record demand for PC during the pandemic and it's sort of backing off. But she was going to say the focus is, and I'm quoting here, premium gaming, commercial portions of the market. So, they're looking at, not the at-home guy, AI stuff, and Xilinx is going to allow them to compete there and gain market share. So that's looking to be pretty good there. So I just want to update you guys there. I think it was a great day, big up day, largest since 1978, but also proved to be the low that set up a significant rally. So anything's possible. Just wanted to update you guys. Hope that helps. And we'll see you guys tomorrow. We have a Thursday live stream that we always do, 3:45. Ryan and I will be doing it. And it'll be on our YouTube channel at New Age Wealth Advisors. Hope that helps. See you guys.